Hello guys, welcome back to a new video, and in today's video I want to educate you guys on how to take fundamental data and apply it to a technical chart there as well. If you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoyed the video, please consider smashing that thumbs up button for the YouTube algorithm. Now before we get started, I just want to inform you guys about the services that I do offer, and I've recently added funded trading accounts. So basically passing the account for you, and before you get worried, no, there's no upfront payment. I will pass the phase 1 target of 8% for you before you get invoice on that, but there's a lot of information on the website. So let's just jump straight into today's video there as well. Now before we get started, the most important thing that you need to understand is that it is a known fact that in order to understand how strong a currency is, you need to understand how strong the economy is. Now, we don't have a measuring tape to measure how strong a country's economy is or how strong a country's currency is. So what do? We rely on fundamental data. This data tells us exactly what is happening in the country, and a country that's wealthy or healthy will have a healthy currency as well. But if a country is not, if a country's economy is not doing good, you can expect that country to do bad as well. And that is what we are going to take a look at today. However, if you want more in depth in terms of what is called PPI, what is CPI, and all of that stuff, you can head over to my, well, you are on the YouTube channel, but you can just go to my description and go to the playlist. What you do is click on educational content, and you'll see here I've made some videos how to trade fundamental data, how to trade and do a fundamental analysis. That videos basically goes in depth in terms of how you read this information, so what is called PPI and all of that stuff. But what I do want to do for you guys today is I just want to simplify that information so that you don't have to go through everything that I go when I do my analysis. You can always do it, but if you don't have the time to do it, then you can do it this way also. Now, the first thing that we need to understand about technical analysis, and it doesn't matter who you are, okay? There's only two prices that you can enter in the market. You can either enter at support or you can enter at resistance. Why? Because you can only buy or you can only sell. There is no in between. And I don't care if you did if you did a course, maybe, with let's say FX seeps, maybe, and then the number one say buy in the middle, number two say buy on top. No, there's only two places to buy, and there's only two places that you can enter in the market. The one is at the bottom, that's where we buy, and the one is at the top and where we sell. Now, before we get to that information, the easiest way to do things is to come over to Forex Factory. Now, Forex Factory is a platform that provides you with data, not inside information, but they provide you with data to say that this is what the information was, this is what it is at the moment, this is what the investors are expecting it to be. And in most cases, when the investors doesn't get what they are looking for, the market tend to react negatively from it. So we're going to go back, because there's no data printed yet. We're going to go back to this data that we have that's printed. Now, when you open this, you can see that I'm only looking at the dollar index, because most of the pairs that I trade, or indices or precious metals or commodities, they all correlated with the dollar index. Like gold, it's got a negative correlation with the dollar. We've got the indices like the Nasdaq, the Dow Jones, and the S&P 500, sometimes also negatively correlated with the dollar index. So when I understand the bias, or if I understand what the direction is of the dollar index, it will allow me to make better trading decisions about where those indices or precious metals are going. So if I come and I do my research, and all my research are showing me that I'm expecting the dollar index to increase in value, then I don't have to go and do an analysis on indices and precious metals. Why? Because by definition, I'm expecting them to go lower in price. And if you are that confident that that is what's going to happen, then when you purchase a dollar index, you can already sell a commodity, a precious metal, or an indice on there as well. But you come onto Forex Factory and you'll see the information on here. Now, the most important information that you need to look out for is GDP, interest rates, the NFP, CPI, PPI. Now, CPI is the Consumer Spending Index, and this gives you an indication. In fact, this gives investors an indication of how inflation is going. Now, CPI is directly linked to interest rates. Why? Because if the CPI numbers comes through higher, that means the Feds are more likely to hike interest rates, because that is the only tool or the biggest tool that the Feds have to tackle inflation. So if inflation is high, you can 100% expect the Feds to hike the interest rate. This leads to a stronger dollar index. Okay, what this comes with, it comes with a decline in jobs as well. So how does this work? Let me explain to you. These are the 4 things that you always need to keep your eyes out for, the 3 things that you need to keep your eyes out for. The first thing that we have over here is we have CPI. CPI is a very strong component that traders or investors look out for. That's if you're a trader and not some guy on Instagram who's standing on the car and, pretending to be trading through the stuff that you have. So firstly, we have the CPI. The CPI is the main indicator that is used to understand and gauge how the market is going. Where can the market go? Firstly, if inflation is high, if the CPI comes out higher, we know that inflation is high. Now, inflation is high. Why? Because consumers are spending. They are overspending. So how do you bring that down? The only way to bring that down or to discourage consumers to spend more is you have interest rates increase. So you hike the interest rates. Why? Because once you hike interest rates, this discourages consumers to spend less. You can almost call it, the consumer spending less index, where you can. So you hike interest rates. This discourages consumers to spend more money. Now, how does this affect the DXY and the stock market? And this is what we are going to be speaking about right now. So this is we're going to call this the DXY, and we're going to call this we're going to call this everyone's favorite, which has been trading it for a long time and still not profitable. But we're going to call this the Nasdaq 100. A lot of you should know this, because if you check the history on your trading account, it's probably going to give you some sad vibes over there. But let's look at this analogy over here, right? We have the CPI. The CPI gives us an indication of what we can expect in terms of interest rates. The interest rates tells us where the dollar is going, and the dollar index tells us where the stock market is going. So how does this work? Higher inflation means that the Feds need to bring that inflation down. How do you bring inflation down? You hike interest rates. What does interest rate hikes do? It increases debt for consumers automatically, meaning they've got less room to spend money, but they've now got more money. Well, they've got more money. They have to pay more money towards their debt, meaning that they've got less money to spend on stuff that is not important. So the Feds come in and say, wow, you guys are spending way too much, right? What do? We hike interest rates so that you don't have to spend that much. Why? Because now all of your money goes to your mortgage, your home loans, your car loans, because all of this has got interest rate attached to it. So, well, how does that increase the value of the dollar index? Easy. As an investor, if I hear that a currency is going to hike their interest rates, I will be there to invest in it. Why? Because I'll be getting a higher return on my investment. Think of it in this way. You have Bank A and you got Bank B. Bank B will give you 6%, which is what we currently get in South Africa, 6.45% with Nedbank. they will give you 6.45% per year. But to make this understandable, think of it in this way: you've got bank A, you've got bank B, right? Bank A say we will give you 1% interest rate, sorry, a 1% interest on your investment. Bank B say, you know what, we will give you 3% interest on your investment. Which bank are you more likely to put your money in? The one that's going to give you a bigger return. So this is what investors do. They come here and they say, we want to invest in the dollar because why? We will get a higher return on our money. And because of that, you know, the dollar see an increase. Now, why does the stock market, especially the Nasdaq, fall? It's easy, because the Nasdaq is a composite that's made up of 100 of the top tech companies located in the USA. This is Amazon, Apple, Google, Microsoft. All of these companies rely on consumer spending. But if consumers are filled with debt because of high interest rates, that means consumers doesn't have the money to buy a new iPhone or product on Amazon. And as a result of that, the company's share prices on the stock market, they drop. Because why? Nobody wants to invest in a stock that they know is not going to make money. And there we see the dollar index, the stock market fall. Now you take the same concept and you reverse it entirely. If the consumer spendings are low, it means inflation's coming down. That means that the Fed doesn't need to hike interest rates anymore, because consumers are now not spending as much as they should. The Fed starts hiking interest rates at a lower point, 0.50, 0.25. Investors say, well, we're not interested in the dollar index anymore. Bye-bye, we're going to go. Stock market increases in value. Why? Because due to a lower interest rate hike, consumers are now having another bit of money left available for them to once again spend on the stock market or the companies that is listed on the Nasdaq 100 there again. So that was a mouthful. So let's come back to the chart here very quickly. So there's only two places to buy in the market, okay? And I'll give you a quick breakdown. If you've been here watching my videos for a long time now, you already know what I'm going to say. So we're going to use this over here, okay? Now we're going to use this. This is what we call resistance. This is what we call support. And this is basically, you'll see why I use this here. In fact, I don't need to use it, so because I'm trying to not confuse you guys on this information. So we're gonna do this, right? So, and then we'll go back to there. So we're gonna call this resistance. In fact, let's call this the ceiling, okay? Think of the resistance as the ceiling, and think of support as the floor. Now, the floor is the lowest that your house can go, even if you've got a double story, but you still have a floor there at the bottom. Now, the ceiling is the highest place that your house can go, and the floor is the lowest point. The only two places that you can buy and sell is at your ceiling. Why? Because you can't go higher than your ceiling, so you have to return back to the floor. And the same goes here. The best place to go up again is from the floor. So you can't go from the ceiling up. You have to go up from the floor. So what happens here is if something happens and you get out of your house onto the roof, now your ceiling becomes a support for you, because if you break out of your house, you can now stand on your ceiling, and that means you can now move higher. That means the level of ceiling has now become a floor, or the level of resistance has now become support. The same thing happened here is if you fall right through the floor, you will be below the floor. If you want to crawl up, your head is going to hit the floor, and you would be going if you need to go lower. But because the floor is not below you but above you, and anything above you becomes the ceiling or becomes a level of resistance. Now with that, keep in mind, there's only two places for us to enter the market. if we come over and we look at the dollar index, high impact news, and we look at for any news that is positive, what we do is we come over to the dollar index and we look for floor prices that we can buy because we expect the dollar index to increase in value. And the only thing you do is you come and look at these green little signs, because that will give you an indication of whether the data was good or bad. But like I said, focus on the CPI, NFP, GDP, interest rates. Those are the main key components. But like I said, you can head over to one of the videos that I've done in the past to understand the abbreviations. And then if the news is positive, then you come here and you look for buying places at the floor. But remember, if the ceiling gets broken, the ceiling will then become a floor. And if the floor gets broken, the floor will then become a ceiling. And remember, we only sell at the ceiling and we only buy at the floor. And when the floor gets broken, it becomes the ceiling. And when the ceiling gets broken, it becomes the floor. If you look at the dollar index is kind of stuck in between. Now, can you say that this is that we can expect the dollar to go weaker? No. Can you say it's going to get stronger? No. Why? Because saying that means that you are probably just another Instagram trader that don't know what they're talking about. Why? Because if you look at the technical aspect of the dollar index, you will know that the dollar index had broken below the strong level of support. That support got broken and became resistance. The market broke above resistance, remember, okay, and that resistance is now turned support. Now, keep in mind that there is a high probability that the dollar index can continue higher from where it is now. But we have one problem. We also have a market that is now stuck between this level of resistance over here that was once support. Now, if you've been here long enough, you would know that the best way to approach this is to wait for a clear break above that level, and on the retest, start looking for a continuation to the upside. And the best place to sell this would be to wait for a clear break of the floor, a retest of the ceiling, and then wait for that continuation to the downside. And the best place to buy it is to wait for a clear break above the ceiling. Ceiling will become support, and then you can start looking for buying opportunities. My good friends, that's all from my side. And before I go, if you do want to, you're more than happy also to head over to CNBC, and you can go read even further about these news events there. Like I said, my personal advice to you is to not do it, because then you might just confuse yourself. So what I've given you was the easy way to do it. Okay, and that's all from my side. Thank you for your time. Thank you for the support. And as always, cheers for years, my good friends.